So, welcome to chapter 11. We're going to be talking about depreciation, okay, and what it does to affect fixed assets. Well, first off, let's talk about what is depreciation, okay? So, when we talk about acquiring fixed assets, right, we learn that as we use it throughout the years, it slowly loses value over time because essentially when we are using it, right, you essentially are, you know, depleting and making the machinery wear out, wear and tear, right? That's a part of the product, right? When you use it, it becomes the way that we dispose it and how we calculate how much we used it, right? We use the terminology depreciation. So think about it. It's like if you're looking at appraisals, right? When you're appraising something, you're finding out how much it's worth, right? In this case, you're depreciating it, which means that you're making it reflect the value that it is currently. Okay. And what depreciation really does is it basically spreads the cost out amongst the useful life of an asset. Okay, so for example, right, if I buy a printer and I open up the box and I plug it into the wall and start printing, right there, I need to start depreciating because I'm using the asset. Okay, so that's what depreciation is. It's a way of means of how we determine that we're using the fixed assets and we're slowly, devaluing the asset based on how much you use it, how often you use it, and how long the life of a typical equipment usually is. Okay. So again, what are items that can be depreciated? So again, depreciation is only used for tangible assets, meaning you can feel them, right? They have some kind of physical feature that stands, right? And that's the word depreciation there, okay? Now again, over a period of time, fixed assets shall lose its value because again, if you expect that you buy a machine and you used it, right? Think about it in a real life context. If I buy a machine for $10,000 and I used it for 1 year and I decide to, sell it back out to the market, can I sell it for its original price that I purchased it for? Probably not, right? No one would want to buy a used machine off of you for a brand new price, right? So that's where the depreciation comes into play. Well, you need to calculate how much it can still be worth, how much its current book value is, and how you can determine that is by the 3 different methods, okay? Or the methods. We'll talk about that in a second. So here, what are some examples of fixed assets that you can use or that you can depreciate? So again, you could depreciate any fixed asset. So anything that's a property, plant, or equipment. So that can include computers, furniture, trucks, buildings, okay? The only exception to this rule is going to be land. Land can never be depreciated, okay? Reason being is because in higher levels of accounting, you're going to learn that land is going to be depleted, okay? Not depreciated, okay? There's a huge, in context, the words and terminology, they all do the same thing, right? But in context, right, you have to know which word to use in correspondence. So when we take a look in chapter 11.4, right, if you guys read chapter 11, you're going to learn another one that's for intangible assets, which is called amortization. They do the same thing. They all devalue the asset in a way that reflects their current book value. So in this case, depreciation for fixed asset, intangible assets is for amortization, and again, depletion is for land. Okay, you deplete land because if land has some kind of value, such as natural resources in it, right? It holds a value. But if you take those natural resources out from the land, you're going to deplete the land. Okay, so remember here, land is going to be one of those tangible assets that you can never depreciate. Okay. So then, of course, when we talk about depreciation, there are two rules, right? When we acquire the fixed asset to begin with, right, we must remember the rule of Acct, where it states that you must record it at historical cost. So that means in our books, when we purchase it, you're going to purchase it at full price value or fair market value. The day that you buy it, whatever cost that you spent to purchase it for is going to be what you record in your books. You can never, ever revalue it or record it at a significantly lesser value, okay? That is against Acct right there because of the historical cost value, right? Now, how do we measure depreciation? Well, that's where we have to create a contra account to kind of reflect so we know what the book value is if we potentially do want to sell our fixed assets in the future. But in this case, right, we do not take depreciation directly out from the actual cost of the asset, right? You cannot devalue a fixed asset, right? So think of it in real life terms, right? If I bought something for $10,000, can I write in my book that it's now worth $5,000? Did I spend $5,000 to use my machine? Okay, think of it in that aspect, right? That's merely impossible. You spent invisible money to use an asset. Okay, so that's why you have to remember this rule here that when you purchase your assets, it's going to stay its value at historical cost value until the day you dispose or get rid of that asset. Okay. And of course, matching principle, right? When we depreciate our assets, it must match the historical cost value of what you originally purchased it for. Okay. So let's go ahead and talk about the components of how to calculate or how to just do depreciation in the first place, okay? So, of course, you need to determine the cost of the asset, okay? Second thing you're going to do is you're going to determine the estimated useful life or the expected use of for production, okay? Which is I'll explain to you in this section here. And then you need to determine a salvage value, also known as a residual value. So what happens when the asset has ended its life? Does it have a value at the end of its life? Okay. And then, of course, the date that we placed it into service is going to be very important. Okay, not the date that you purchased it, but the day that you place it into service. Okay, and of course, the depreciation method that you're going to use to calculate the depreciation. Okay, so let's go talk about the first component here, which is going to be the cost of the asset. So in this case, right, the true definition of this is going to be all cost that it takes to get the asset ready for service. Okay? All cost it takes to get the asset ready for service. Okay? So that can include, right, the originally selling price, the sales tax if there's included. If the product had to be shipped to your store, then yes, you need to count that in there, right? In order to get it ready for service, it needs to be at your store. Okay, any product fees, so anything that you may have to do, such as subscriptions to the product. Okay, anything like installation fees, like if you have to install it and it costs money to install, then you need to include that. If someone needs to be a trained professional to use this type of machinery or equipment, that's going to be included in the cost of the asset as well. Okay? So again, these are going to be all things that you're going to be um, required to know to be part of the cost of the asset, because the purpose here is not getting it to your store. It has to go even further than that. It has to be ready for service. Okay? Then we're going to talk about estimated useful life and salvage value. Now, there are two rules that you need to know here, okay? That under Acct, right, as a sole proprietor, you get a little more leniency than a person, or a business organization that is a corporation, okay? Under corporations, so Acct and the IRS, they boggle down on making sure that your assets are at zero at all times. Okay, so meaning, right, the salvage value will always be zero. So that means at the end of its life, it should hold no value. Okay, and of course, when we talk about the estimated useful life, so every type of fixed asset has a lifespan. Okay, now how is that usually determined? Well, there's other key factors that you can use to determine, right? So an example, right, a printer, depending on how often you use it, how much you use to print, can determine how long it's going to last you. Okay, now in most cases, as a corporation who's going to be using a printer, they're going to be printing thousands and thousands of pages per day. So you can already imagine that that kind of printer will not last at all for them. So in this case, right, for the IRS, they do have give a book that allows you to look up your asset and determine. These are already predetermined numbers. So the number scale is usually 5, 10, 9, and 11. Okay. Now, I didn't tell you about 9 or 11 just because in this class, I want you to just get the basics. But usually when you depreciate buildings, you have the 9 or 11 rule. Okay, 9 years or 11 years. In this case, the most common ones that you will see frequently is going to be 5 or 7 years. Okay, on average, a computer should last you between 5 to 7 years. Okay, that's an example. Okay. And again, under corporation rules, they say that no, at the end of its life, there should be no residual value left. Okay. But as a sole proprietor, when we talk about leniency rules here, you can get away with coming up with your own estimated useful life as well as your own salvage value. Okay. Now, in this case, because as a sole proprietor, right, your likelihood of using your fixed asset is definitely at a smaller scale. You're not going to be printing thousands and thousands of pages if you buy a printer, right? So easily a printer can last you at least 10 to 15 years, right? Depending on how often you print. If you're only printing 20 pages per month to print out invoices, then you can only imagine how long can that printer really last you. It can last you for a long time. But of course, given with management being able to determine the estimated useful life of the asset, you have to also be realistic. Can a printer really last you 10 years? Especially given to the idea of technology, right? How do you think technology is going to last you 10 years? That is the question there. So in this case, right, extensive research needs to go into this to determine the right estimated useful life for the asset. But if you're, like I said, like if you're just winging it or ballparking it, your best bet is just go to IRS to go find that Blue Kelly book of all fixed assets and just grab one of these numbers so you don't have to do the research. Okay? But realistically, when you think about it, right? When you're looking at your fixed asset, use some kind of reasonable number that's actually something that you can reach. So, for example, a printer, right? it should last you 5 or 7 years. Okay, maybe it could last you 10 years, bare minimum. Okay, or maximum is 10 years. Okay, management gets to choose and determine the estimated useful life. Okay, under sole proprietors. Okay, and also we also as sole proprietors get to determine whether an asset is going to have value at the end of its life. Okay, great example, right? You buy a truck. Now, do you expect that you're going to drive the truck down to the ground? Absolutely not. As a sole proprietor, you're not going to be driving as much as corporations would be driving, right? Corporations would be driving all over the United States. They would be taking they would be traveling, stuff like that. They would take long trips, etc., etc. Whereas a sole proprietor, right? If you buy a truck, right? You're not going to drive it down to the ground. You're going to probably barely make, make long trips here and there. Okay? And as a sole proprietor, right, you're not going to value it at zero, because if you're only driving it for so many miles per year, right? And let's say you can say that this truck can last you at least give or take 10 years. Give or take 10 years, right? On average for a car. Therefore, at the end of its life, it should hold some kind of value, whether it's, scrap metal, $5,000 or something like that, right? Because at the end of the day, right, when we're looking at a sole proprietor, we're not using it as often as a corporation would. We're not, running it to the ground. We're not constantly, speeding or anything like that. We're using the truck to just drive from point A to point B, right? And that's it. Okay? So the damage that you do on an asset would probably be least likely due to, compared to a corporation who would just drive it just to drive it. In this case, right, you are, as a sole proprietor, get the privilege to also determine that at the end of its useful life, that there is some kind of salvage value. Of course, that does have to come with realistic numbers. You can't say, I bought a $35,000 truck, at the end of 10 years, it's going to be worth $10,000. No, it's got to be dealt with research. And again, you can use a Blue Kelly book for a truck to determine what your value could be after its life, okay? And how many miles that you've driven it for, okay? So again, and we're going to be focusing on maybe a mix between both, but just know that depending on what kind of company you work for, whether you are a sole proprietor partnership, or if you decide to work for a corporation, right? That's the standard rules that you need to know between when it comes to depreciation. Okay? Then we're going to talk about the date that you place it into service. So, okay, this is where I'm going to be introducing you to what partial years means, okay? So when we talk about assets, right, and we talk about how it has an estimated useful life, we treat our assets just like we treat our babies, right? The day that it was born is going to be the day that you count from there how old the baby is, right? You don't say when the baby comes out, right, and let's say it's August, right? You can't just say, okay, that baby's 1 already, right? No. You count it as if based on age. So in this case, same thing. If an fixed asset, has an estimated useful life, the date that you place into service is going to determine the day that you start depreciating it. Now, what's most important is going to be the exact date as well. If you depreciate it between the first 15 days, okay, that means you covered more than 50% of the month. That means you're going to depreciate it that month, okay? If you depreciate it and or place it into service after the 15th, all the way to the end of the month, then of course, right? If you let's say you place into service on the 25th of January, are you gonna count 5 days of depreciation? No. It's just that 5 days of depreciation is gonna it means nothing, okay, compared to more than 50%. So in this case, what you're gonna do is, if you do put it after the 16, right, it's less than 50% of the month. You're just gonna assume that you can just go ahead and depreciate it the following month, okay? So that rule is very important, and of course, the day that you place into service. So if it's June 1st, then you're going to depreciate it as of June 1st, all the way till either the end of the year or to the following June 1st. Okay. Same thing here, right? If you do June 17, then you're going to depreciate the following month, which is July, and you start depreciating and counting its life from there. Okay. All right. So again, you need to be able to recognize the date that you place in service, because that's going to be considered partial years, and you need to make sure that you depreciate each fixed asset accordingly based on its age, not the current year that you're in. Okay, that's the most important thing there. Last but not least is going to be component number 5 here, where we're going to be determining which type of depreciation that we're going to be using to calculate depreciation. Okay, this one, there's a bunch of different methods out there that exist, okay, whether you're a corporation, small business, partnership, whatever kind of business that you are, okay? And again, IRS, they actually limit you to two specific methods to use: straight line and double declining. But in this case, right, I'm going to teach you a couple other ones, but if you are a corporation, they would recommend you to use either or, straight line or double declining. But as a sole proprietor, you have the capability to do any of these 6 that are listed here. Now, of course, I'm not going to sit here and teach you all 6 methods, okay? I'm only going to teach you 3 out of the 6 methods. In this case, this is just only 6 that are commonly used. There's there's way more different depreciation methods beyond this. So in this class, we're going to take a look at 3 different depreciation methods, right? First one we're going to look at is activity-based, also known as units of production, okay? It's important that you know either or, because someone could say, I want you to use this activity-based method, okay? In here, this class, it's just easier to recognize it as units of production, okay? They're the same terminology here. Activity-based, units of production, same thing, okay? Straight line method, okay, it's a pretty straightforward one. It's straight line, all right? And the third method is going to be accelerated, also known as double declining, okay? Accelerated, meaning you're gonna increase or go fast, or also known as double declining method, okay? So the first one that we're going to be looking at is going to be the very first one, which is going to be activity-based method, or also known as units of production. Okay. Any questions so far?
No.
Okay, so let's go ahead and dive right into units of production, okay? These right here are going to be the formulas that you will be needing to know in order to complete or fill out the depreciation table, okay? So yes, there's tables in here. All right, first one's going to be determining the depreciation basis. All right, so as far as this, right, when we look at all of these equations, the depreciation is very easy. Okay, you're going to be given all the information that you need in order to plug in here and be able to determine depreciation. It's that easy. The only difference is you need to know the difference between the three different methods and which formulas to use between the different methods. But it's a simple plug in and solve. Okay, so in this case, right, the depreciation basis is going to be the cost of the asset minus salvage value. Okay. Then for activity based, right, you have what's called a per unit rate. This per unit rate is going to be your depreciation basis divided by the total number of units that can be produced, okay, over its life. Okay, production over its life, okay? And then, of course, the depreciation expense is going to be the number of units that were produced that current year multiplied by the per unit rate, okay? And then, of course, accumulated depreciation is going to be your previous year's accumulated depreciation plus the current year's depreciation expense. And then, of course, book value is going to be cost of the asset minus accumulated depreciation. Okay? So all of these are going to be basically the equations for you to fill out the table. Okay? So let's go ahead and dive right here into the first example where we are going to record the depreciation for the first year. Okay? In this case, we have a machine. That's our asset. The asset cost is going to be $15,000. Salvage value is $2,500. Its useful life is 5 years, and that means over the course of 5 years, it should be able to produce a total number of 10,000 units. Okay? And of course, the date that we place into service is going to be January 1st. Okay? So there we go. We have the 5 components that we need, right? Number 1, asset cost. Number 2, estimated useful life or number of units that it could produce. In this case, 10,000. Right? Do we have a salvage value? Yes, we do. Right? That's part 3. Part 4 is determining the date that you place into service, January 1st. Okay? And then the last thing that we need to make a note here is what method are we using? Units of production. Okay? Now, in this case, we'll talk about partial years in a few seconds after this example, but let's go ahead and just do the example here. So, when I acquired my asset as of January 1st, okay, at the end of the first year, I produced a total of 2,100 units, okay? So let's go ahead and go through each and every single equation. So first one I have here is going to be determining my depreciation basis, which is going to be my cost of the asset minus salvage value. So in this case, what's the cost of my asset?
15,000.
What's my salvage value?
2,500.
So in this case, what is my depreciation basis going to be?
12,500.
12,500. So the next equation here is going to be my per unit rate. My per unit rate is going to be my depreciation basis divided by the total number of units that can be produced. So in this case, my depreciation basis is 12,500. Okay? And the total number of units that it could produce is going to be 10,000. That's my capacity. Okay? So that's important that you understand it that way, okay? My capacity is that it can produce a total amount of 10,000 units. So in this case, what is 12,500 divided by 10,000?
1.25.
$1.25 per unit. Okay? So in this case, right, let's go ahead and solve what my depreciation expense is going to be, which is going to be the total number of units produced that year times the per unit rate. So in this case, that year I produced up to 2,100 units. And if it's going to cost me $1.25 per unit, what is going to be my depreciation expense? 2,625. So then my accumulated depreciation formula is going to be my previous year's accumulated depreciation plus my current year's depreciation. In this case, this is my first year depreciating. Do I have a previous year's?
No.
No, so that's automatically 0. And to add my current year's depreciation expense, which is 2,625, so that's my accumulated depreciation. And then now I need to solve for my book value. Okay? So my book value is going to be cost of my asset minus my accumulated depreciation. So in this case, what is my book value going to be? $12,375, okay? So in this case, right, that's how we fill out the table. It's straightforward. All you have to do is just plug in your numbers and you'd be able to solve for it, okay? Now in this case, right, it is based on the number of units that I can produce that year, right? Hence the word units of production. So my depreciation is not based on the life that it has. It's based on how many units I can produce and do I meet a capacity, okay? So in this case, if year 2 rolls around and I decide that I produced 2,000 units, let's go ahead and solve for the rest. So in this case, what is going to be my depreciation basis? All right, depreciation basis is still going to be your asset cost minus salvage value.
12,500.
12,500. What about my per unit rate?
The same.
It's going to be the same. It's still going to be $1.25. Now this time, the difference here is going to be my depreciation expense. Okay, so in this case, because I produced 2,000 units, and if it cost me $1.25 per unit, what is going to be my depreciation expense for year 2?
2,500.
2,500. Okay, and of course, you plug in my previous years, which is my 2,625, plus my current year depreciation expense of 2,500, gives me a grand total of 5,125. Right? And then the last thing I gotta do is I gotta solve for my book value, which is your $15,000 minus the 5,125. I should be now left remaining 9,875. Now, what's so important about this book value over here? This book value basically determines, well, if you decide that this machine isn't for you, you at least know what to be able to expect when you do sell it back out to the market. What is it currently worth? In this case, right, if I were to sell it as of year 2, it's now worth $9,875 at least. Okay, obviously when you sell it, you're not going to get the exact amount, but at least it gives you a rough estimate of what it can be still valued at. So when you do sell it, right, you're going to write off your books that you bought this asset for $15,000, but you're going to recognize its book value. You're going to recognize the depreciation expense, and you're also going to recognize the cash that you got for selling this item. Okay? And we'll talk more about that example in Coffee Cafe when we reach the end of chapter 12. Okay? So that is it. So what you're going to notice is that your total number of units produced every single year is going to differ. Okay? However, what you're going to notice is that your depreciation basis and your per unit rate is going to be constant. It's going to be consistent, it's going to stay the same. Okay? And the only difference here is when you're calculating your depreciation expense, it's going to be based on the number of units that you produce that year. So that's going to fluctuate. Okay? And notice this, at the end of its life, so 5 years, right? Your accumulated depreciation should be matching with what your depreciation basis was. Okay? Which was your asset cost minus salvage value. So that means at the end of its life, these things should match. So that there's this, and then of course, at the end of the 5 years, right, your book value should equal to salvage value. Okay? So that is this when you solve for it completely out. Okay? Now, of course, let's look at this little capacity over here, right? We said that the capacity had a capacity of 10,000 units, right? Now, what happens if, let's say, my capacity, let's say I was able to produce extra, okay? If I were to produce a little bit extra, now, case is this, okay, right? When you have a capacity or an estimated amount, right? And if your machine decides to just produce a couple more, what you're going to notice is that oftentimes, usually at the end of its life, right, and you end up producing extra units, the likelihood of those, extra units are most likely going to be defective items. Okay? Because at this point, right, it's already been 5 years. The machines, the rubbers, the metal, right, it's been rusted. It's been, it's been used, right? The oils in the machine are not, they're not running properly, right? A lot of things can happen, especially when you're looking at machines, right? Maybe the springs are not springing anymore, okay? There's a lot of things. The technology, maybe the technology, it doesn't run efficiently anymore, right? It's starting to slow down. The machine's overheating. So there are many problems when it comes to reaching its end of its life. And if you do end up producing more, how would you depreciate it from here? Okay, so let's go ahead and solve for it. So if the depreciation basis, right, is going to stay the same and the rate's going to stay the same, but this time I need to calculate my depreciation expense. Okay, so if I have $1.25 per unit and I produce 2,200 units, what's going to be my total depreciation expense for year 5?
$2,750.
2,750, and of course you plug it in and you're going to get 12,750, and then you're going to get a book value of 2,250. Now, I'm going to tell you this rule. This can never ever happen. Okay? 1, you reach beyond capacity. Okay? Meaning those 2 extra 100 items that you have produced, like I've mentioned before, most likely it is high risk at being a defective product. Okay? Now, of course, you would still, you check the product to make sure if it's good, if it's not defective, then of course you could put that into your inventory. However, when you depreciate the actual machine, you're only allowed to depreciate it for its capacity amount. So that means it cannot go beyond 10,000 units because that's what the capacity was set out for, 10,000 units. And second rule here is that your book value can never fall below salvage value. Okay? That is a key rule here. If your salvage value is 0, great. If your salvage value is some kind of value, you cannot depreciate it below to the point where your book value will fall below salvage value. Okay. Now, is there any way that I can revalue or add value, fix my machines, and add value to this? Yes and no. Now, again, that's going to be a little more advanced level of accounting. Because when you add fixtures, so in this case, right, maybe this machine needs to be maintenance, needs to do an oil checkup, needs to get its rubbers replaced, okay? If that's the case and you need to add money to this, right, what you're actually essentially doing is you're just expanding the life of the asset, okay? You're just expanding the life of the asset, okay? In regards to adding value to it, of course, you're making a fixture to your fixed asset, okay? So in this case, yes, you can revalue your asset if you do any fixtures, maintenance, or repairs, or anything that needs to do when it comes to, extending the life of your fixed asset. But once again, that is a little advanced level of accounting in regards to that, because there are some rules and regulations on what you can and cannot recognize. But at the end of the day, right, yes, you can readjust your salvage value if you do add fixtures and so on and so forth to it. Okay? But for now, if it falls below salvage value, that's a big no-no. Okay? So that means you have to just revert it back to 2000 and have it come out evenly, exactly that, because you have to meet the capacity. Okay? All right? Any questions here?
No.
Okay. So how do we journalize our depreciation expense? Okay, so here's our example that we just did, right? We for the first year, we produced 2,100 units. My rate was $1.25 each, which gave me a depreciation expense for 2,625. Straightforward, right? If it's the end of the year, end of the month, depending on what the given circumstances is. So in this case, it's the end of the year. End of the year meaning December 31st. So in this case, right, I'm going to be recognizing two accounts: depreciation expense, which is given, and a contra account, which is called the accumulated depreciation. This accumulated depreciation is a contra account to the actual fixed asset. Okay? So when this is a contra account to the fixed asset, right, in your books, if you break it down, right, you have the historical cost value of what the fixed asset is, and then you have your contra account to give you your total book value. Okay? So in this case, that's exactly what I'm going to have here. All right? So in this case, I have $2,625. Okay? Now, what happens if I had to do it for the second year? So in this case, second year rolls around. It's still going to be December 31st, but this time I produced 2,000 units, giving me a depreciation expense for 2,500. Okay, how would I journalize my depreciation for year 2?
With a debit on depreciation expense and credit accumulation.
Mm-hmm.
Depreciation.
For what amount?
2,500.
That's correct. Now, don't get confused here. In your table, your accumulated depreciation right now is 5,125. That is the balance, okay? That is what your current balance is when you depreciate every single month, right? Or every single year. Because in this case, right, we're adding our previous year with with the second year, right? This is our account balance. Where on our journal, right, do we ever see balances in our journal? No. you only journalize the transaction that happens during the year, right? You don't see any account balances here. So that's the separation. So don't get confused that just because it says accumulated depreciation, make a note here. This is on the table right here for year 2 is an account balance, where in your journal is where you need to recognize it, so then you can have this account balance. Okay? And that is it. So let's talk about what happens when we need to consider partial years. Okay. So for this example, right, we have a machine, okay, that we purchased, okay, for $10,000. Its useful life is 5 years, and its capacity producing is up to 25,000 units. Okay, it has a salvage value of 2,500 at the end of its life. Okay, and the machine was put into service on October 18. Record the depreciation for the first year. So in this case, right, I have October 18. So what does that tell me?
Depreciation value starts the next month.
Correct, right? Because it's past the 15th. So therefore, the month of October, you wouldn't count because it's less than 50% of the month. So therefore, I'm going to start depreciating as of November, and I only have November and December, okay? Now in this case, right, let's take a look. Let's say my first year ends on December 31st. So therefore, I have 2 months that I've accumulated. And for that year, I've only produced 250 units, okay, for my first year, which is 2 months. So in this case, let's go ahead and solve for my depreciation expense. So start with the depreciation basis. Cost of my asset is $10,000. Salvage value is $2,500. So my depreciation basis is going to be
7,500.
7,500. Oops. And then the rate is going to be the 7,500 divided by your capacity of 25,000, which gives you 30 cents. So in this case, right, for my first year, I am depreciating it, right? I made a total of 250 units. And if it cost me 30 cents per unit, then I multiply that to get a total of $75. Now notice this. In this case, right, my first year tells me that I only produced 250 units. In this case, right, when we talk about this one, when it's not time sensitive, because the main idea here is we're not focusing on how long or how old the asset can, produce its amount, right? We're focusing on a capacity. So in this case, right, if year 1, you only recorded 250 units, right? And it has a capacity of producing 25,000 units over a course of 5 years. Think about it. You should be able to be producing thousands of items. But in this case, my asset's only 2 months old. So in this case, between the span of 2 months old, under the first year, November and December, it's telling me I only produced 250 units. So in this case, this is where partial years does not have an effect with depreciation, okay? Because you don't care about the time. You care about how much is being produced that year, okay? And then, of course, you journalize it just exactly like that, okay? So in this case, partial years does not matter, okay? The depreciation expense does not, is not affected, oops, grammar there, by the date that you place into service, because it is not counting it's based on how many units is being produced that year, not when you place into service or how old the asset is. Okay, so in this case, not time sensitive. Okay, but just because it's not time sensitive, that doesn't mean the next couple depreciation methods that we take a look at, they will be time sensitive. Okay, so partial years is something that you need to look out for the next couple of depreciation methods that I teach you the rest of the week. Okay. So course review, once again, we talked about what depreciation is. There's 5 components that you need to have in order to complete your depreciation. What is depreciation? Okay. Oh, and we also need to know that a depreciation is considered an adjustment entry, right? Because what are we doing here? We're adjusting the number of how much we used our fixed asset at the end of a given accounting period. Okay, you don't do it randomly. It's not like it's not like anything else, but it's definitely an adjustment entry. Okay. Here, this gives you an example of how you journalize a depreciation expense and what the rules are when it comes to what you can and can't do. Okay, and the 5 components that you need to have in order to use depreciation. And for this particular example here, for the 4 units of production, these are the exact formulas you need to have. Okay. And again, units of production is based on a capacity, not based on the date, not based on the length of time that an asset has. It's based on a capacity. Okay. All right. Any questions in regards to chapter 11.1?
No.
Okay. So let's dive right into the exercises, okay? So let's take a look at the question number 1. So question number 1, question 1 through 3, okay? Question number 1 says here that, okay, you purchased a printer, okay, for $150, okay, with no salvage value. Okay, its useful life is 5 years and it can print up to 10,000 pages. Okay, and of course you put this machine into service as of January 12th. Okay, so let's go ahead and fill in the information here. What kind of asset did I buy?
A printer.
You bought a printer. Okay, how much did that printer cost me? $150. Okay. Was there a salvage value?
No.
No salvage value. Okay. Does it have an estimated useful life?
Yeah, 5 years.
5 years, but in this case, that doesn't really matter to us. Actually, it does in context of how old the asset's going to be, but so on and so forth. Number of units that it can produce.
10,000 pages.
10,000 pages, okay? And the date that we placed into service? January 12th.
January 12th.
Okay? So assuming that you do a depreciation at the end of the year, December 31st, okay? So here are the numbers of units that you could produce within those 5 years, okay? So the first one here, we have 2,100, okay? So let's go ahead and determine the depreciation basis. So what's my depreciation basis going to be?
150.
150, right? It's going to be your asset cost. Let me find my F4 key. Asset cost minus salvage value, which is 0, okay, will give me $150. Right? 150 minus 0, 150. Okay. What's going to be my per unit rate?
Divided by 10,000.
Divide by 10,000. Okay. Okay. So in this case, I'm using absolute self-referencing. So when I drag my formulas down, I'm constantly taking this one cell. So that's what the dollar signs mean. If you are trying to do a specific cell and keep that like calculating that it's going to be constantly calculating 10,000 minus 0, and you want to drag that formula all the way down, that's what absolute cell referencing is. It's going to be your F4 function key. Okay. So in this case, how much is going to be my per unit rate?
And a cent, 1 cent and a half.
1.5 cents. So let me see. Okay. Yeah, it's going to be 1.5 cents. Okay. So then let's go ahead and determine if I printed 2,100 pages that year. Okay, how much is my depreciation expense for year 1? I'm going to use equal round.
$31.5.
$31.50. Okay, so then what is going to be my accumulated depreciation?
The same, right? Because it's the first year.
Correct. If it's the first year, right? The formula is previous years plus current year's depreciation expense. So in this case, I don't have a previous year. So in this case, it's just going to equal $31.50. So therefore, how do I determine what my book value is going to be?
$118.50.
$118.50, right? We're going to take my asset cost of $150, okay? And we're going to subtract out my $31.50 to give me $118.50. Good. All right. So then let's go ahead and solve for the second year. Okay. For the second year, I produced 2,200 units this time. So what's my depreciation basis is going to be for year 2?
The same.
It's going to be the same. So if it's going to be the same for the second year, it's going to be the same for all 5 years. Okay. What about my rate?
The same as well.
If it's going to be the same for the second year, it's going to be the same for all 5 years as well. Okay? So this time, right, the difference I have here is that every year I'm going to have a different depreciation expense because it depends on how many units I produce that year. So in this case, what is going to be my depreciation expense for year 2 if I printed out 2,200 pages?
$33.
$33. Okay, so then what is my accumulated depreciation going to be? So in this case,
$450.
I'm going to add this together to get $64.50. So then what's my total book value going to be?
$85.50.
$85.50. Good, right? Making
I'll
sure.
be
Go ahead.
back. My dog is crying.
That's fine. So remember, right, you're going to take your asset cost minus the accumulated depreciation, which right here, 150 minus 64.50 is going to give you 85.50. Okay? All right. So what about depreciation expense for year 3? $28.50. Okay. Giving me a total accumulated depreciation to be
$61.50.
60. We're adding 64 plus
Do the
28.
Oh, we're adding 64. I'm sorry.
Okay. Okay, so that should give you $93 even. So then what's my book value going to be?
57.
57. Okay. So then, let's go ahead for year 4. I produced 2,000 pages. So what is going to be my depreciation expense?
$30.
$30. Okay. So that gives me a grand total of accumulated depreciation to be
$123.
123, bringing my book value to be
27.
$27. Okay. Last but not least, right? If I produce a total of 1,800 units, okay, what's my depreciation expense going to be for year 5? Okay, 27, right? Which brings me to 150, which brings my book value to be at the end of 5 years to be 0, which is salvage value. It's equal to salvage value. So that's...
Does that actually ever really happen where it comes out to an actual 0?
In this case, we would have to, because your salvage value is 0. Now, you will see an occasion when we're using double declining, when you do get to, if you have a salvage of 0, you're going to be going on and on and on and on and on until it gets to 0. So yes, it does eventually get to 0. Okay? And it really depends, yeah. It depends on how you...
Say we had just like $2 or $3 left. You would have to have another 6 year and then whatever would be left in those units produced in order, like, do I have to get to 0? I guess my question.
It depends. If like, once you reach the 5th year, right, and it is the 5th year, you have the choice. You can either dispose it with $2 left remaining and just get rid of it and count and just take a loss on $2, or you can exhaust it all the way on the 6th year and just depreciate until it hits 0. Yes, you can. You have 2 options. However, if you push your capacity beyond its, I think this one's 25,000, right? If you push it beyond it, most likely cases you're going to get defective products. So it just really depends. If you feel that $2 needs to just be rid of, that's fine. If you want to keep pushing it until that $2 is up, that's also fine too. Okay.
Thank you.
So there you go. So now question number 2 says, record the adjustment entry for the first year. So in this case, first year of depreciation, how much was my depreciation expense?
$31.50.
Okay, so assuming that we're doing at the end of the year, so December 31st, how do I journalize this transaction?
Depreciation expense and accumulation depreciation.
Yes. Okay. Depreciation expense and accumulated. I'm going to put accumulated depreciation. Okay. For the $31.50. Okay. And then question number 3 asks to record the adjustment for year 2, or for the second year. So in this case, second year, how much did I depreciate it for? $33. So how should my journal look like? It should look identical to this one because it's a new year now. Okay? But this time, instead of depreciating it for $31.50, it is now for $33 because it's the second year. Okay? All right? Everyone good? All right, so let's go ahead. Everyone good? Any questions here?
Yep.
Okay. So last example here. Okay. We have question number 4 through 6. okay, you purchased a truck for $36,080, okay, which includes all fees and taxes with a salvage value of $5,000, okay. Its useful life is 7 years and it has mileage up to 150,000 miles, okay. And of course, you put this truck into service as of August 25th, okay. Assume that adjustments are made at the end of the year, okay. So in this case, what did I buy?
Truck.
You bought a truck, okay. How much was the truck worth?
36,080.
36,080. What's its salvage value?
5,000.
Salvage value is 5,000. Okay. What's its estimated useful life?
7 years.
7 years. Okay. What is the number of units that it can produce?
1,000 or 150,000 miles.
Yeah, 150,000 miles. Okay. And what's the date that you placed into service?
August 25th.
August 25th. Okay. So on the first year that you drove your truck, you drove it for 10,000 miles. Okay. So in this case, let's go ahead and plug in our answers here to solve for our depreciation basis. So what's my depreciation basis going to be?
31.
So asset cost of 36,080 minus my salvage value of 5,000 gives me a total of 3180. Okay. What's my per unit rate going to be?
Uh, 20 cents and 72.
Okay. So in this case, I have to round my answers because in this case, right, I have roundable. This one I have an unrounded number. So in this case, I need to use equal round to solve for my depreciation expense. So in this case, if I drove 10,000 miles for the first year, how much is going to be my depreciation expense?
2,072.
Okay, 2,072. So then what's my accumulated depreciation for year 1?
2,072.
Okay, which brings my book value to be
Is it 29,008?
no, you use the depreciation basis.
34,008.
It's the asset
34,000.
cost. Correct. Asset cost of the 3680, okay, minus the accumulated depreciation of 2,000. Okay, so remember, don't get confused. Don't take the depreciation basis. It's going to always be asset cost. Okay. So therefore, my truck is now worth 34,000 if I plan to sell it. Okay. So let's go ahead and solve for the rest of the years here. So in this case, right, what's my depreciation basis for the second year?
The same.
Well, same.
Yeah, so in this case, I'm going to drag it all the way down. Whoops. I think, yeah, there's this one. needs to be merged, and this one needs to be merged. Okay, so there you go. There you go. Okay, they're all going to be $31,880. Okay, what about my per unit rate?
Same.
That's also going to stay the same for all 7 years. Okay, now in this case, if I drove 25,000 for my second year, what's my depreciation expense going to be?
5,100.
5,180. Okay, so then what's my total accumulated depreciation going to be?
7,252.
7,252, which brings my book value to be
28,828.
perfect. Good. Okay. All right. For year 3, I drove 19,000 miles. So my depreciation expense for year 3 is going to be
3,936.80.
good, bringing me a total accumulated depreciation. So 7,000 plus 3,000.
11,188.80.
Good, which brings me to a total book value of 'What's my book value for year 3?
I can do it, but I need the regular, what is it, 36,080?
Yes,
What was it?
36,080. Yeah,
It's 24,891.20.
good. Okay. So then let's continue on with year 4. Okay. This time I drove 20,000 units or 20,000 miles. So my depreciation expense for year 4 is
41.44.
good. Which brings my accumulated depreciation to be
15,332.80.
good. 15,332.80. Okay. Which brings my book value down to
20,747.20.
good. Okay. Year 5, if I drove 18,000 miles, my depreciation expense for year 5 is going to be
37,29.60.
good. All right, bringing my total accumulated, so 13,332 plus 3,729 should give you
19,062.40.
19,067.40. Which,
Six.
go ahead.
Yeah, that's right.
Okay, which brings me down to 17,000. Okay. So then year 6 rolls around. I drove 22,000 miles. So in this case,
4,500. $2,558.40.
Good. All right. My total accumulated depreciation is going to be
$23,620.80.
good, which brings my book value down to
$12,459.20.
good. Okay. Last year is the 7th year. We drove 26,000 miles. So in this case, what's my depreciation expense going to be for that for the 7th year?
$53.87.20.
Okay. Bringing my accumulated total depreciation going to be
$29.08.
good. Bringing my book value to be down to $7,072. Okay. Now, in this case, right, have I met my salvage value?
No.
No. Also, how old is my asset right now?
7 years.
Is it really 7 years?
No, because we started in August.
Did we start in August?
Well, no, September.
We
It's August 25th, September.
exactly. Good. We start in September. So September, right? September, October, November, December. It's only 6 months and 6 years and 4 months old. So that means we still have another capacity to go for an 8th year. Now, an 8th year in terms of accounting years, but in this case, the asset hasn't even reached its full capacity either. So in this case, we can go for another course of an 8th year. Now, what was my total capacity? How much can I drive up to?
150,000 miles.
150,000 miles. So right now, how many miles can I actually drive up to for my 8th year? So in this case, I'm going to do a quick equal sum here. Good, right? 10,000. Right? If you add these all up, you currently have 1,400,000. So you need to do 10 more thousand to get 1,500,000. Okay? So again, if I need to drive 10,000 more miles, okay, for the last remaining of its life, okay, of course, the depreciation basis is going to stay the same, as well as my rate. It's going to also stay the same. So in this case, what's my depreciation expense going to be for year 8?
$2,072.
2,072, which brings me a total accumulated depreciation of
$31,080.
31,080, which brings your book value down to 5,000. Okay, so this is what you need to make a note of, that the right here, these are accounting years, not the years of the asset. Okay, so again, now that we have 8 years, but really it's not 8 years because the date that you place into service, so that we call that partial years. So in this case, now the asset has reached its age, which is completely 7 years, and it's reached its capacity of 150,000 miles, and it has the book value to equal salvage value. Okay, all right. So let's go ahead and answer questions 5 and 6. So let's go ahead and record the adjustment entry for the first year, assuming that the adjustment entry is at the end of the year, December 31st. So in this case, what was my depreciation expense for the first year?
2072.
2072, right? And how do I record this adjustment?
Depreciation expense and accumulated depreciation.
Good, right? Depreciation expense and accumulated depreciation. Okay? For the $2,072. Okay? All right. Next question here for question 3 is question 6 is to record the adjustment entry for the second year. So in this case, same exact journal entry, but this time it's another year. Okay? And this time, how much did I depreciate as of year 2?
5180.
Depreciation expense for 5180. Okay? Okay. Any questions in regards to the depreciation method that we learned today? Units of production.
No.
Okay. All right.
No.
Okay, so again, this concept is very simple. All you have to do is plug in your variables into the exact, plug into the formula, and you should be able to solve everything just completely fine. All you have to do is just make sure that you know exactly the components that you need to do the depreciation, and you also need to know which depreciation method you're focusing on. So in this case, this was just units of production. So this is the formulas that are involved with units of production. Tomorrow, we're going to look at double declining, okay? And then Wednesday, we're going to take a look at straight line, okay? So other than that, if you don't have any other questions, you guys are free to go. All right, have a great rest of your